Okay, the next section that we're going to talk about is called money management. And within this section, we're going to talk about specifically how to diversify your portfolio. We're also going to talk about what are known as trade repairs or rolling a trade. This is a very important component of trading. When trades come under pressure, as they sometimes will, and the risk is there and we need to manage the risk, sometimes instead of just getting out of the trade, we can actually roll the trade or adjust the trade to try and not lose as much money in the position. So we're going to cover that as well as we go through this. So let me just click to the next slide. This slide, if you take a close look at it, is an example of diversifying our strike prices. So whenever we're entering trades with the Option IQ software, one thing that we want to keep in mind, and I've mentioned this multiple times throughout the class, is that we always want to set different trades. We never want to put all of our money in one set of boundaries, or one call option and one put option. We want to make sure that we never set the same type of trade twice. In other words, if I already sold a 1230 call for this month's expiration, I don't ever want to sell another 1230 call again. And the same is true on the put side. If I've already sold a 925 put, I don't want to go out and resell a 925 put in another trade for the same expiration. That is to help us diversify. And if you look at this slide, this concept is kind of explained. And here's the key. If I've gone in and sold a 1230 call at the beginning, this was my first trade that I got into, and I sold a 925 put, and I've put about, depending on whether I have a large account or a small account, somewhere between 7 to 10% of my account value into that one trade, what I'm going to do is I'm going to wait until there's another recommended trade that has different boundaries, that has a different call strike price and a different put strike price. Now, how different? Again, on the call side, we want to always have a minimum of 5 points. So if I already sold a 1230 call, I'm going to sell something either 1235 or 1225. I will never resell the 1230 call for the same period of time. Now, 5 points on either side is kind of what we're trying to look for at a minimum. If we can get more, let's get more. Let's diversify even more so. So same thing is to be considered on the put side. If I've got a 925 put, instead of just 5 points on the put side, we do 10 points. So I'm going to either look for a 935 put to sell or a 915 put. 10 points different on either side if I'm going to get into a new trade. So we never want to sell that same 925 put again. So you'll notice that's also, oh, by the way, that's also at a minimum. So if we can get more than 10 on either side when we're going to get into a new trade, then it's going to be even better diversification. So if you'll notice the very next trade, the one in the middle here, this shows that now I've waited enough time, the market's moved enough, that now I can sell a 1230 call, which is actually 30 points lower than my previous trade on the call side, and I can sell an 895 put, which is actually 30 points lower on the put side. So I've actually gone out and diversified by not setting the same trade or the same boundaries again in another trade. And I've offset the trade by at least 5 points on the top and at least 10 points on the bottom. In this case, we're 30 points lower on both sides. Once again, I now have 2 trades instead of just 1. So now my next trade that I work into and put another 7 to 10% of my portfolio amount into is also going to have diversification. What does this mean? I now have a 1230 call and a 1200 call. So now I've got to look for something different than those two by at least 5 points on either side at a minimum. And then on the put side, I've got the 895 put and the 925 put. I've got to also look for something 10 points higher or lower on either side so that I don't ever reset the 925 or the 895 put again for this expiration. So my third trade, if we look at it, here we have the 1170 call and we have the 865 put. So because the market, even though it's moving up and down here, because it's kind of starting to go down, it's kind of moving in a downward trend, you'll notice that our new trades are actually laddered lower than our previous trades. So we now have 3 trades, and each one of those trades is laddered a little bit lower than the previous trade. If the market turned around and started going up, we could do the exact same thing by laddering the trades, moving up and kind of following that market depending on where it decides to go. So this is true diversification, never putting the same money in the same boundaries for the same expiration. This is something that we harp on, that we want you to focus on. Here is why. When a trade comes under pressure, as it will, and you are looking at the trade and you're trying to decide, should I get out, should I hang on? Well, the key is you should get out. And it always makes it easier to get out and take a loss if you have other trades that are diversified that have a chance of actually making you money during that same period of time. Yes, I have some trades that are losing, but yes, I have some trades that are still winning and might end up, working out. So that is the key. If you can diversify correctly over time, it's only going to benefit you, as far as performance goes, long term. So once again, this is diversifying. Let me show you an example of this. So this is an actual account. Now this is within the software. So if you go into your active trades, if I go back here and click on My Trades and Active Trades, right here, if I click that box, I'm going to be able to get to my entire account. And what it's going to bring up is it's going to bring up essentially a graphical representation of all the trades that I have going in the market right now. You'll notice in green, this shows what the market is actually doing. Each day it's going up or down, depending on what type of market activity we're having. And then each one of these red lines represents a sold call, and each one of the red lines down here represents a sold put. So what you'll notice is, in this example, you're never setting the same exact trade twice. You've always got that diversification. So let me explain. If the market decided to continue up, it looks like it's starting to roll over now, but if it continued to go up and got too close to this red line here, this 2050 strike price, we might end up having to exit that trade and take a loss. But the good news is even though we'd had to exit that and take a loss, these other trades up above at 2060, 2070, 2075, and all the way up to 2125 would still potentially have a chance of working out and making us money. So diversification, true diversification, is where you can take a losing trade and get out of it and make the right decision because you know that you've got other trades that are in a better position that potentially can work out. So it kind of takes some of the pressure off when you have a losing trade, knowing that, hey, I've still got all these other trades that are looking good and they have a potential for working out. Also on the bottom, if this market rolls over and continue to go down and got really close to this put at 1825, the exact same thing is true. I might have to exit this trade at a loss. But below that, I have all these other boundaries going all the way down to 1700 that will also be in play during that same period of time. So although I might be losing on some trades, I might also have some trades that are still working out and potentially will be profitable, depending on what the market decides to do. Having said that, this little graphical representation is just a quick way for you to kind of get an overall overview of the account and how you're doing, where the market is in relation to your trades. Okay, on the next slide it talks about how to diversify. So even though I've kind of shown you how to diversify, let me just make sure that I cover this. And I think I covered this earlier on during the class, but we're going to cover it once again just kind of as a refresher. It says here that Option IQ suggests never putting more than 7 to 10% of your account value into one trade. And again, this is all based on the size of account you have. If you've got a larger account with a significant amount of money that you're trading with, you can afford to really diversify. Maybe 7%, maybe 8% of your capital in your account into each trade. If you've got a smaller account, maybe say around $10,000, the minimum trade is about $900 to $1,000. So you're going to be able to put in about 10 trades with a $10,000 account. So with those smaller accounts, we want you to just put 10% of your account value into any one trade. But again, really important to follow this, to get really diversified, because you might go months without the market doing anything to your hitting. You might go months without the market hitting a 40% probability factor. But I can tell you this: the month that it does hit a 40% P factor, you're going to be grateful, or you're going to wish that you diversified, depending on what you choose to do. So again, very important component there. Next is how to watch the futures price. So remember, we trade options on the index futures contract. So whenever we're watching our trade, we're not looking at TV, we're not watching CNBC and trying to decide, based on what we're seeing on TV, where is the market in relation to our trade. Now, what we have to do is we have to actually go onto the software and look up the actual prices. So let me show you how this is to be done. If you pull up the software, underneath I believe it's the Market Update button here, you can scroll down to where it says Market Data. If you click on this little button, it's going to bring up all the information for the indexes, or the future indexes or index futures that we're trading. So here we have the E-mini S&P. You'll notice you have what's called the cash S&P above that. This is not the one we want you to look at. We want you to look at the E-mini S&P here. And if you want to, you can see the price of 1997.5. This is actually live right now. And if you'd like to, you can actually click on a chart here, and the software will launch an actual chart. It's got some studies on it. You can come down here and remove indicators or overlay indicators. But essentially, it just tells you everything that you need to know about the index. Specifically, the price is what we're looking at. So once again, just as a caution, don't monitor your trade based upon where the market is on TV. Make sure you go out and you're looking at the right specific index futures contract that we're trading to know where your trade boundary is in respect to where the market price is today. The next concept I'd like to discuss is known as the Rapid Repair System, also known as RRS. When trades reach a 40% probability factor, and you realize that now it's time to begin exiting, Option IQ would say that's the best decision. We believe that getting out of a losing trade is really the most conservative choice. When you hit 40, we suggest you get out as soon as possible. However, having said that, if you would like alternative strategies, Option IQ can assist you with alternative, what we call repair strategies. We can suggest these strategies to you through your dedicated trade representative. So the dedicated trade representative will contact you and can give you these trade adjustment recommendations for each trade that comes under pressure. Now again, bullet point 4 here on my screen is probably the most important. There is no guarantee that this rapid repair strategy or approach to managing a losing trade will result in any profit. In fact, it could actually cause the trade to experience greater losses. Let me explain. Before I do that, just a standard hypothetical results disclaimer. What I'm about to show you is considered to be hypothetical in nature. So I'm just using a hypothetical example to explain the concept of trade adjusting or repairing a trade. So here's an example of a trade. If we look at it quickly here, we can see that we have sold a 2025 call. We've bought a call above that, which we have not put the strike price on there for that particular position. And we've sold a 795 put, and we've bought a put below that as well. We've noticed that during this trade, the market has chosen to rally, and it's moved up closer and closer to our sold call option. At this point, we've reached a 40% P factor, and according to Option IQ rules, we should consider exiting immediately. If I go to the next screen, there is the ability to close the trade out and exit today or exit the next day, depending on when you look at it, by just buying back what you originally sold and selling what you originally bought. In other words, I'm buying back my sold call and I'm buying back my sold put. I'm also going to sell my bought call, which was my protective call, and I'm also going to sell my bought put. If I do that today, this particular trade would result, hypothetically, in a $200 loss. Now, having said that, what if I chose not to do this? Is there another idea? Is there something else I can do? And again, going back to the RRS system or approach, we could give you alternative strategies and ideas to help you possibly adjust this trade. An adjustment to this trade would be something like this. First, we only choose to exit the top of the trade. In other words, we choose to buy back the call that we sold, and we also get out of the we also get out of the call that we bought, is what I meant to say. So we buy back the sold call, we sell the bought call, and now we've completely closed out the top side of the trade. You'll notice that the bottom side of the trade is being maintained. We're maintaining the sold put at $7.95, and we're maintaining the bought put that's below that. This would result in a lower loss or a smaller loss than our previous hypothetical example. The reason that that is the case is because when we get out of our puts, they actually cost money to get out of, simply because we're closing them out before we've made all the potential profit that we can make on those options. So because those options are not near the market, they're fine, they're getting profitable, but if we choose to close them out early with the rest of the trade, we're going to give up some potential profits that we could have made if we held those puts all the way to the end. So by just closing out the entire trade, we are going to lose a little bit more. If we choose to just exit the side of the trade that's under pressure, we're going to lose a little bit less. So here's an example of about a $25 a smaller loss. So instead of $200 loss, by doing this, we only end up losing $200. Now, why is that important? Well, here's why. What we're going to do now is we're going to adjust the top side of the trade. We're going to leave the bottom alone, let it stay where it's at. We don't really need to do anything. There's no pressure there. And we're going to adjust the top side of the trade. And here's how it would work. We would move the top side of the trade to a new suggested parameter. In this case, we've moved from 2025, where we originally sold our call, to a new strike price of 2050. That is a 25-point increase. So we're buying back the 2025, and we're selling a new call option at 2050. We're also selling the protective option that we originally bought, and we're buying a new call option above the 2050 strike price. You'll notice as soon as we do that, our probability factor has now changed. Instead of 40%, which was our rule for got to exit immediately, it's now only 20%, which means I no longer have to exit this trade. In other words, what I'm doing is I'm moving the trade further away so that potentially I can survive and maintain this trade and take it all the way to the end. What I'm essentially banking on here is that the stock market or the index price does not continue to go up in the remaining days of this trade. As long as it doesn't continue to go up and doesn't hit a 40% probability factor at the new 2050 strike price, I'm going to be able to take in $100 in profit from adjusting this. So I took a $175 loss when I got out of the call side. Now I'm getting into a new call side and I'm taking in $100 in profit. So if you look at the result, if it stays within the boundaries, it never triggers a 40% P factor on the 2050, and it doesn't reverse and go all the way back down and threaten the 795 put that we originally sold, all of our options expire at expiration, and they expire worthless, meaning they're not worth anything. The good news in that is that originally when we exited the trade, the losing trade, we took a $175 loss. Now remember, we didn't get out of the entire trade. We could have, and lost $200, but we chose to only exit the call side. So that's why I'm showing the $175 loss here. We then entered into a new trade or new parameter that was suggested by your dedicated trading representative. That new trade, again hypothetically, ended up working out. And so the $100 that we brought in new profit when we sold that 2050 call and bought the call option above it ended up offsetting our loss of $175, so that we, as the trader, would only realize on this trade a $75 loss. Now, are there more aggressive ways to adjust trades? The answer is yes. But anytime you adjust a trade and become more aggressive, you always have the chance that it could backfire on you and you could potentially lose more money than you had originally lost if you would have just got out of the trade to begin with. So again, this is an example of a hypothetical adjustment, and this is the concept of what we're going to help you do when trades come under pressure. For more information on this, please contact your personal or your dedicated trading rep, personal dedicated trading rep, and they can answer questions on that for you. Now, let's talk about this PTR, Personal Trade Representative. Working with them is like always having someone that understands the software in your back pocket. They're going to be your best resource when it comes to using the OptionIQ trading platform. They will assist you in setting, monitoring, and exiting trades. They can assist you with the advanced strategies. They can assist you with live quotes and understanding where the market is right now, understanding how to read market data. They can also help you when trades come under pressure and we need to, or you want to, implement a repairing or a trade adjustment. And then lastly, they are also going to help you create and stick to what we call a success blueprint. So as you begin using the software, we want to help you set some goals. What are you trying to achieve? What are you trying to accomplish with the OptionIQ software? Let's set some realistic goals, and then let's help you work towards achieving those goals. So with that being said, that is the end of the presentation. That is the end of the weekend. Thank you so much for being here and participating. If you have any questions or concerns, I'll address those if you want to come up and talk to me. Otherwise, you can contact us. Here's our information listed there on the slide. Thanks again. It's been my pleasure being with you here this weekend.